Today we're going to be starting Unit 3, which is all about journals and source documents. Prior to this in our accounting journey, we'd really been focusing on mastering the accounting equation, those account titles, the order of certain accounts, and really understanding
Debit on the left, get it from the right, debit left, get it right, debit left, get it right. For complete satisfaction, balance all of your transactions.
Asset increasing is a debit. An asset decreasing is a credit. The reverse is true for liabilities and equity. If you get this, then you get accountancy.
And from here on out, we're going to be using this accounting cycle and going into what's called journaling. After we journal, we'll be working on the chart of accounts, which is something that you secretly have been doing up until now. And then we're going to be using what was on our journal and putting that into what's called a general ledger. And the information from our general ledger will create a worksheet, and the information from our worksheet will create the two financial statements most commonly found in a business, the income statement and the balance sheet. So everything from here on out will be building this flow chart of accounting and this cycle of accounting, and it all starts with what's called journaling. So in lesson 3.1, we talk about what an actual journal is, what source documents are, and then how we record our transaction entries into a journal. So prior to this, we've been using all of these lovely T accounts like this. And who here is sick of having to draw out 2 T accounts for every single transaction? So if you're feeling a little like Karen and Gretchen Wieners, have no fear. That's what the journal's purpose is. So the first thing we need to do is define what a journal is. So a journal is an actual form that we're going to use from here on out to record our transactions on. And it looks like this. Now it's important to note that journals are done in chronological order. So we will go from the start of a month to the end of a month in journaling, in accounting. And the word journalizing is the actual action verb here. So it's the act of taking our transactions and recording them on the journal. So the journal itself is the form, and journalizing is taking our transactions and putting them onto the journal. And we do journalizing every single day. So every single day we journalize our transactions, and those are done again in chronological order from the start of a month to the end of a month. So when we record the transaction onto the journal, this is actually going to be called an entry. And in accounting, we use what's called double entry accounting. And the reason it's called double entry is because there will always be 2 accounts that are recorded for every single entry. And the debits are always equal to the credits. So this is nothing new that we have 2 accounts and
Balance all of your transactions.
And that's just the reason that we call it double entry accounting. So if you ever look at a line in a journal and you only see 1 debit or you only see 1 credit, that's going to be wrong because we don't have our 2 or our doubles. So if we take a deeper look at our journal, it does have a couple of special things about it. The first is that it's organized by special amount columns, which are journal columns that use an account title for the name. If we look at this journal, we'll see that there is a specific column called sales credit, and the account title here is sales. There is a specific column with the title cash, both for debit and credit. So these are special amount columns, and they're special because they have that account title in the name. And the reason we have these is because sales and cash are both used very, very frequently in our transactions. And I'd like you to note that there is no sales debit column because sales is never ever going to be a debit. It's always going to be a credit. So we have the special amount columns, and then a journal is also set up with the general amount column. The general amount column is a journal column that does not have a specific account title. It just has the general debit and the general credit. And so if we look at the accounting T and we cross out our sales and our cash, that would mean that anytime we use accounts receivable, supplies, prepaid insurance, accounts payable, any expenses, and any capital or drawing accounts, those would all get recorded in the general amount column. The sales and the cash, again, are recorded in the special amount columns. So before we can look at how we journalize an entry and transaction into our journal, we need to discuss what source documents are. So source documents are business records where the information for our entry is actually found. And there are 5 different source documents we'll use in accounting. The first is a check. The second is a sales invoice. The third is a receipt. The fourth is calculator tape. And the fifth is a memorandum. And so these source documents use the document number column on a journal, which is this little tiny one next to the account title, and we're going to break each one of those down. Now you might be like, well, why the heck does this matter? So source documents are what we consider objective evidence, or they're actual proof that the transaction occurred. So it's not just your word, it's physical proof that you can show if you ever get audited, or if the government is like, well, where the heck is this money coming from? That's where you're able to pull out the source document. So at this point, we're going to break down each one of those 5 source documents and show how you would record that in the document number column on the journal. So this is what a check looks like. Most of you are familiar with the right side of a check, but you haven't necessarily seen the left side of a check. So this is actually what the checks look like here at the school. The left side is something that usually stays with the business, and the right side is what gets handed off when you are purchasing something either from a person or from another business. So in the document number column, when we use a check as a source document, we will put C and then the number. So on this check, it says number 1, so the document number in our journal would be C1. And anytime we write a check, this is essentially saying that we are paying cash from our business's account. So if I pay cash, that means I'm going to be decreasing my cash, which is a credit, and I'm going to be receiving something else as a debit. So my debit is actually whatever's on my 4 line. So in this case, my 4 line is supplies. So I'm gaining supplies, and that's my debit. And my cash is what I'm paying, or it's decreasing. So my cash is a credit anytime I use a check. The next type of source document is a sales invoice, and this is what one would look like. In the document number column, our sales invoice is going to be recorded as S and then whatever number it is. So the sales invoice says number 1. We would record this on our journal as S1. A sales invoice is used whenever we sell a service on account. So typically there's a duplication made with the sales invoice. So the customer gets a copy and then the actual business gets a copy. And if we look at this, it says sold to Oakdale School. So our debit is going to be our accounts receivable to whoever we sold from, because they're going to owe us money. And sales is always, 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 always our credit in a sales invoice. The third type of source document is a receipt, and the document number here is going to be R and then our number. So in this example, it would be R1. A receipt is used when you receive cash, so receipt. It's when you receive cash for anything but sales. So when we receive cash for sales, that's on our invoice, but a receipt is cash received for anything but sales. So if I receive cash, cash is my debit, and then my credit is actually who I am receiving or what I am receiving it for. So in this receipt, it says for investment. So my credit here would be my name and capital account. Calculator tape is the next type of source document, and we record this on the document number column as T and then the number. So it will actually always tell you on the calculator tape, this one says T12, and that's what we'd use in our document column. Calculator tape is always used when you receive cash, but only on one specific day. I like to think of this as like garage sales use this, or sometimes concession stands, but it is receiving cash for only one specific day of sales. Now, the calculator tape can be kind of confusing. It's always the bottom number that's the total number. So if I look at these 3 numbers, 150, 35, and 110, if I added those 3 together, that would equal 295. So when you look at a calculator tape, it's always the bottom starred number that you're going to be recording on your journal. So if I receive cash, cash is what I'm debiting, and then my credit is for something that I sold that day. So sales, again, is always a credit with calculator tape. Our final source document is a memorandum. Memorandums are documented as M and then the number. So this one would be M1. And they're basically a brief message or brief memo when there is no other source document to use. And they'll read exactly as a transaction that you've seen previously. So this one says bought supplies on account. So you would work it just like a regular transaction. Your keyword here is supplies. So you'd be debiting supplies because that's what you're gaining. And then your other keywords here are account and bought. So if I buy something, that means I have to pay for it. So I'd be accounts payable to Supply Depot for my credit.
So now that we know what a journal is, we are going to practice actually using it to record our transactions rather than using all those little mini T's. So the very first thing you'll do when you get a transaction is to create a T account for that transaction. Now it's up to you if you actually want to write those T accounts down, or if you're able to just memorize those and think of them in your head, that's awesome. I'm going to show it to you with them written down just because sometimes I honestly still have to do that to make sure that I'm correct. So we will start first by identifying our keywords just like we've always been doing. So when it says on August 1st, received cash from owner as investment, my first keyword here is cash. So I'll draw out the cash T account. Then my second keyword is owner, and it goes with investments. Owner's investments are the name, comma, capital account. So I'll draw out that T account. Now I'm ready to actually put my information for my transaction in my journal. So there are 4 parts to writing a transaction in a journal. The first is the date. So I'm going to take August 1st and I'm going to drop that in the date column. Then I'm always going to start by listing my debit followed by my credit. So when I receive cash, cash increases. So cash is my debit. So I'm going to go ahead and I'm going to list cash. Now cash is a special amount column, which means it's already got this column titled with the account title. So I am going to drop cash in the cash debit column, and it is for $5,000. So I put $5,000 right there. Then I'm going to drop in my credit. Well, my second account here was capital. And so I look at the journal, and capital is a general amount column. There is no column titled name, comma, capital. So I'm going to put the $5,000 credit under general. And then if ever I put any dollar amount in general, I have to list the actual account title's name under the account title. So I've written name, comma, capital. And then the fourth thing I'm going to do is put my source document, which is R1 for receipt 1, in the doc number column. So when you are doing a journal, it's very easy. You should at minimum have 4 things: the date, the debit, the credit, and then the doc number. And then you'll either have a 5th or a 6th thing, depending on how many numbers you have in the general column. So I only have 1 number in the general column, which means I only need 1 additional account title. If I have 2 numbers in the general account column, which is something you'll see in the next section, then I would need 2 account titles. So let's just practice this again. August 3rd, paid cash for supplies. First keyword here is cash. Second keyword here is supplies. I'm going to drop my date in the date column, so August 3rd. I'm going to drop my debit and credits in. So when I pay cash, cash decreasing is a credit. When I gain supplies, supplies increasing is a debit. So I can put my cash in the special cash amount column under credit. And then I can put supplies, which is a general amount column, under account title. And then if I have a credit in cash, I'll have a debit in supplies. And then I'll drop in my source document, which was check 1, so C1. Again, I've got the date, I've got a debit, a credit. My 4th thing is the doc number. And then my 5th thing is that account title for supplies because I used a general column.